Welcome back to Curious Commerce, continuation from part third of working capital management. Now we will discuss about the positive versus negative working capitals. Positive working capital means current assets is greater than current liability. It shows the business has enough short-term resources to meet its obligations. Positive working capital indicates business is financially strong, expenses are under control, income is properly managed, company has reserve funds. This is the indicators of the positive working capital. For example, a grocery shop with cash of 30,000 rupees, stock of 70,000 rupees, debtors of 20,000 rupees, total current assets rupees 1,20,000. The liabilities of the grocery shop, creditors 60,000 rupees, outstanding expenses 20,000 rupees, total current liability 80,000 rupees. Current assets minus current liability, that is the working capital formula, right? So the 1,20,000 rupees minus 80,000 rupees, the net working capital is positive 40,000 rupees. Meaning of the positive 40,000 rupees is business is healthy. On the basis of this example, positive working capital is like strong immunity for business. Because of the positive working capital, business can pay suppliers on time, buy raw materials without delay, pay salaries regularly, pay rent, electricity, taxes, avoid unnecessary loans. For example, a textile shop receives bulk order. Because it has sufficient working capital, it purchases raw material immediately and delivers order on time. Operations run smoothly, right? Sufficient working capital keeps the business engine running smoothly. Once again, I will repeat, sufficient working capital keeps the business engine running smoothly. But in the case of the negative working capital, the negative working capital means current liability is greater than current assets. It indicates the danger situation of the organization. The negative working capital indicates liquidity crisis. The liquidity crisis means no cash to pay immediate bills, delayed in salary payment, suppliers start refusing the credit facility, unable to pay the EMIs, stress in daily operations. For example, a mobile shop has stock of rupees 40,000, cash of rupees 5,000, debtors of rupees 10,000, total current assets will be rupees 55,000 rupees. The liability, the total liability of that mobile shop is rupees 90,000 rupees. The working capital is negative 35,000 rupees. The business is struggling, right? Negative working capital is not just shortage of money, it is shortage of control. The negative working capital indicates the risk of business or the risk of business failure. If negative working capital continues, business reputation damaged, credit rating goes down, bank loans may be rejected, suppliers demand advance payment, business may shut down. On the basis of this indicator, many businesses do not fail because of losses, they fail because of poor working capital. Too many credit purchases plus slow collections leads to negative working capital. When businesses buys goods on credit frequently, creditors increase. But customers pay slowly, debtors collected slowly, right? Then current liabilities increases, current assets do not convert into cash quickly. The end result will be working capital become negative. For example, a wholesaler purchases goods rupees 1 lakh on credit, sales on credit 1 lakh 20,000 rupees. Customers delay payment for 3 months, so creditor want money now, but debtors are not paying it. It leads to cash shortage, negative working capital, and liquidity crisis. On the basis of the above numerical examples, when money goes out faster than it comes in, working capital turns negative. Once again, I will repeat, when money goes out faster than it comes in, working capital turns negative. Positive working capital shows strength, stability, and smooth functioning. Negative working capital shows liquidity stress and risk of failure. Successful businesses always monitor their working capital carefully because survival depends more on cash flow than on profit. Once again, I will repeat, successful businesses always monitor their working capital carefully because survival depends more on cash flow than on profit. Current assets are those assets which are expected to be converted into cash within one accounting year or operating cycle. Simple idea for the remember, current assets are nothing but future cash. Current assets equals to future cash. Cash and bank balance. This is the first item we consider as a current assets. This is the most liquid asset. It includes cash in hand, cash at bank, petty cash, demand deposits. But why it is important? Because it is used for daily expenses, salary payments, electricity, rent, transport expenses, and the emergency payments. For example, a shop has rupees 8,000 rupees in cash and rupees 42,000 rupees in bank. Total cash in hand and cash at bank is rupees 50,000 rupees. Cash is king in business. Cash is king in business. The second transaction we consider as a current asset is the inventory. Inventory means stock of goods held for sale or production. It includes raw materials, work in progress, and finished goods. Why this inventory is current asset? Because it will be sold and converted into cash soon. For example, a bakery holds flour, sugar as raw material, cake under the preparation, that is work in progress, ready cakes for sale, that is finished goods, all are inventory, right? All this inventory is converted to cash in future period. Unsold stock today becomes cash tomorrow. Unsold stock today becomes cash tomorrow. The third, the major component considered as a current asset is the debtors. Customers who purchase goods on credit, they owe money to business. For example, you sell goods worth rupees 10,000 to some X on credit. That X is your debtor, right? Why debtor is current asset? Because businesses expect to collect cash from them within short time. The credit period is very short. If debtors delay payment, cash problem arises. Debtors are cash in waiting. Debtors are cash in waiting. The fourth component is bills receivable. Bills receivables are written promises from customer to pay money on a specific future date. It usually comes in form of promissory note or bills of exchange accepted by debtor. For example, customer signs a bill. I promise to pay rupees 5,000 rupees after 2 months. This becomes bill receivable for business. But why current asset? Because it will become cash on maturity date. Bills receivable are confirmed future cash. That's why we consider bill receivable as current asset. The fifth component is short-term investments. These are all the investment made for short period, usually less than 1 year or one financial year. For example, fixed deposit for 3 to 6 months in a bank, treasury bill, generally called as in the TBs, mutual fund, especially the liquid funds, marketable shares bought for short-term profit. But why it is current asset? Because they can be quickly sold, easily converted into cash. For example, business invest rupees 50,000 rupees in liquid mutual fund for 4 months. If you consider the duration of that mutual fund is 4 months, this is the current asset. Short term investments are parked cash. Short term investments are parked cash. All components of current assets have one common goal: they will convert into cash. That is why we say current assets are future cash. Efficient management of these assets ensures smooth working of the business. Current liabilities are those obligations which must be paid within one accounting year or operating cycle. The simple idea: current liabilities or future payments. Current liabilities or the future payments. The first component we consider as a current liability is creditors. Creditors are suppliers from whom goods are purchased on credit. It means businesses buy goods now and pay later. For example, you purchase goods worth rupees 20,000 from a wholesaler on credit. The wholesaler becomes your creditor. But why creditor is current liability? Because business must pay them soon, usually within 30 to 90 days or 1 month or 3 months. If not managed, the creditors delay payment leads to supplier stops credit or the credit facility. Business reputation suffers. Creditors are not enemies. They are temporary financiers of business. Creditors are not enemies. They are temporary financiers of the business. The second component of current liability is bills payable. Bills payable are written promises by business to pay a certain amount on a future date. It arises when suppliers draws a bill and business accepts the bill. For example, you accept a bill that I promise to pay rupees 10,000 rupees after 3 months. For business, this becomes bills payable. It is a liability. But why the current liability? Because it will go out as cash on maturity. Bills payable or confirmed future payments. That's why it is the current liability. The third component is short term loans. These are all the loans taken for a short period, generally less than 1 year. For example, bank overdraft, cash credit, working capital loan, short term business loans. Why are taken? To meet daily expenses, to purchase stock, to manage seasonal demand. For example, business takes rupees 1 lakh overdraft from a bank for 6 months. This is the short term loan. That's why we call it a current liability. It is for the 6 months only. Short term loans solve today's problems but create tomorrow's payment. Once again, I will repeat: short term loans solve today's problems but create tomorrow's payment. The fourth component is outstanding expenses. Outstanding expenses are expenses already incurred but not yet paid. For example, outstanding salary, outstanding rent, outstanding electricity bill, outstanding telephone charges. For example, salary for March is rupees 50,000 rupees but paid in April. Salary outstanding becomes current liability. But why does a liability? Because business is legally bound to pay. Business is legally bound to pay. Outstanding expenses are hidden payments waiting to be paid. Outstanding expenses are hidden payments waiting to be paid. All components of current liabilities represent money that must go out soon. That is why we say current liabilities are future payments. Efficient businesses always control their current liabilities to avoid liquidity crisis. Thank you all. For daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. If you like this video, please like, share, and subscribe. Thank you all.